I do want to say it is with great pride that I can outline the resilience of the New Zealand economy and its financial system in the face of the COVID-19 economic shock. The ongoing containment of COVID-19 and the significant fiscal and monetary policy support has ensured that the New Zealand economy has performed as well as is possible over recent months. Economic activity contracted severely in the June quarter of this year, and it still remains below the pre-COVID-19 levels of activity. But that significant fiscal and monetary policy support has acted to limit the extent of the shock to both households and businesses. We've used our monetary and financial tools in unison, given that we are a full-service central bank, to help achieve these robust outcomes. The necessary low interest rates have supported the economy, in part by lowering barriers to invest, the hurdle rate for investment, improving cash flows in households and businesses, and of course ensuring that the New Zealand dollar exchange rate remains competitive. The stimulus will continue so as to support the economic recovery and to best ensure that the bank achieves its remit, which is low and stable consumer price inflation, while also, of course, contributing to maximum sustainable employment. Over recent months, it has been very pleasing to see that the business sector has also been innovative, particularly through the adoption of technology and many flexible working regimes and operating practices. Business failures, non-performing bank loans and unemployment have all been much lower than expected at the outset of this COVID-19 economic shock to date. This relatively positive economic outturn means that the New Zealand financial system has not been tested as severely as it could have been. The banking system has maintained strong buffers of capital and liquidity, and the insurance sector remains well capitalised. So while it's very pleasing to be outlining this relatively positive economic news so far, I do want to caution about the economic challenges that remain ahead. COVID-19 remains rampant internationally. This poses significant ongoing risks to New Zealanders' health and economic prosperity. International economic activity is being severely constrained. Uncertainty remains elevated and debilitating. And international border restrictions of various forms will continue for a long time to come. Here in New Zealand, businesses will also face ongoing challenges as fiscal support measures unwind. This will lead to increased loan impairments for banks. Some comforting news is that our stress test conducted earlier this year on the financial system shows that our banks can withstand a significant rise in general unemployment before their credit provision would be questioned and or curtailed. Finally, I acknowledge the actions to meet our inflation and employment remit, namely low interest rates, have spurred activity in the housing market. While consumer price inflation remains at the low end of our target range and unemployment remains above what we would consider the maximum level of sustainable employment, house prices have risen considerably. Rising household wealth and its feed-through into consumer and investor confidence is an important channel for monetary policy to be effective. However, it is only one channel. As I've already mentioned, a lower than otherwise New Zealand dollar exchange rate, reduced financial barriers to invest, and improved business and household cash flows are the other channels at work for monetary policy. All of these channels have ensured that monetary policy remains effective. In terms of financial stability, we have observed an increase in higher risk mortgage lending, particularly by property investors, not owner-occupiers but investors. High-risk loans increase financial vulnerability to households, businesses and banks. For example, high leverage in the housing sector poses a risk should house prices decline or unemployment rises. And we have been talking about this now for a long period of time. To manage this risk, we have announced our intentions to reimpose the loan-to-value ratios, restrictions to guard against continued growth in higher risk lending. And to do so, we're doing so to ensure that banks remain resilient to any future housing market downturn. We also intend to work with government in a rapid, constructive, open manner on assessing longer-term solutions to housing affordability. And this is as requested in the letter received from the Minister of Finance yesterday. The Minister's letter acknowledges the Reserve Bank's goals around inflation and employment remain as they are, and that monetary policy decisions remain those of the Monetary Policy Committee at Te Pūtea Mātua. In our holding response, which we will add to later once we've had time to consider it, I do want to say I'm very pleased and proud of the fact that we've been asked to assist, because we sit here with one of the largest repositories of macroeconomic expertise in Aotearoa, New Zealand. We will be assisting as we go through, but I've already highlighted that we do take housing costs into consideration when both measuring consumer price inflation and setting monetary policy conditions. Likewise, we consider economic and financial risks from asset prices when setting our financial regulatory policy. So we look forward to working with government on the long-term and very complex issue of supply and affordability of houses in Aotearoa. I'm pleased to note that the recent data shows first home buyers are at a record share of the housing market at present, a record share making up 25% of house purchases in the recent September quarter. New home building consents are also at elevated levels on the supply side and at a record level in the Auckland region at present, a record since 1990. But there's always more that can and should be done when it comes to affordability, and we will provide our insights accordingly and work with government with pace and integrity.